Everyone's always talking about government debt, right? Those massive numbers you hear on the news every night. But what if the real debt crisis, the one that actually hits us where we live, is quietly building up in our own neighborhoods? Today, we're going to uncover the debt crisis that's been hiding in plain sight.
Yeah, we're not talking about national deficits today. Nope. We're talking about the money regular people owe. I mean, think about it. The sum of every credit card, every car loan, every mortgage that keeps the wheels of our daily lives turning. This is a story about Main Street, not Wall Street. So what's really the difference here? Well, let's use an analogy. Think of government debt like a huge storm way out on the high seas. It's big, it affects the giant financial markets for sure. But consumer debt, that's a flood rising right in your own neighborhood. It's personal, and you feel the damage right inside your own home. And let me tell you, that flood is getting dangerously high. As of the first quarter of 2025, total household debt in the U.S. shot past a mind-boggling $18.2 trillion. And that's not just some abstract number. It is the highest level ever recorded, and it touches nearly every single family in America. Okay, so where is all this debt actually coming from? Let's start with the most common and maybe the riskiest form, the plastic that's sitting in our wallets, and this new kind of invisible debt that comes right along with it. Right now, Americans owe $1.8 trillion just on their credit cards. Now, to put that into perspective for you, that balance has absolutely exploded by more than 50% in just a few short years, since 2021. This is not some slow and steady climb. It's a meteoric rise. So what makes this kind of debt so dangerous? Well, unlike a mortgage, it's revolving, which means there's no fixed end date. And with interest rates averaging over 20% and some retail cards hitting a totally punishing 36%, it's basically designed to keep you on the hook. And get this, people aren't just buying fancy things. They're swiping these cards for absolute essentials like groceries and medical bills. But hold on, there's a new player in town, and it's creating something people are starting to call phantom debt. You've seen them, right? Services like Buy Now, Pay Later that offers super easy, often interest-free installments. So what's the catch? Most of this borrowing is completely under the radar because it's not being reported to the credit agencies. It's debt that lenders, and sometimes even the borrowers themselves, literally can't see. And its adoption has been massive. We're talking 1 in 5 Americans now using a BNPL service. And while it sounds super convenient, the lack of oversight makes it incredibly easy to just stack up these payment plans without even realizing how much you truly owe until it's way too late. All right, let's shift gears now. We're going to move from short-term debt to the single biggest piece of the puzzle for most families, the mortgage. The very bedrock of the American dream. The scale here is just immense. Americans owe $12.8 trillion on mortgages alone. That accounts for nearly 70% of all household debt. It's the biggest financial obligation most people will ever take on. For years, the story was pretty simple. Low rates fueled a housing boom, millions of people locked in mortgages below 3%, and this created what's now famously known as the golden handcuffs effect. People are just sitting on these amazing rates, which makes them really reluctant to sell and move, and that has basically frozen a huge part of the housing market. But while a lot of homeowners are locked in safely, there are some really clear cracks starting to appear in that foundation. For anyone trying to buy a new home, mortgage rates are at 20-year highs, causing affordability to just plummet. And crucially, we're seeing a steady rise in serious delinquencies. That's people falling more than 90 days behind on their payments. Now for our third major category. This is a type of debt that has completely transformed from what was supposed to be an investment in the future into a source of crushing financial stress for an entire generation. And yeah, I'm talking about student loans. The growth here has been nothing short of explosive. Back in the early 2000s, total student debt was under $500 billion. Today, it stands at nearly $1.8 trillion. That's a more than 3-fold increase in just 2 decades. Wow. And here's the statistic that is truly alarming. Since the payments were restarted after that long pandemic pause, more than 1 in 5 federal borrowers, that's over 20%, are now seriously delinquent. That is a record high, and it's a very clear sign of widespread distress. And listen, this is not just a problem for recent graduates. The largest chunk of this debt is actually held by people between 35 and 49 years old, We're talking about parents who are often still paying off their own student loans while trying to save up for their kids' education. It is a really painful generational squeeze. So we've looked at the individual pieces, right? The cards, the mortgages, the student loans. Now, let's zoom out and really connect the dots to see how all this pressure on individual households becomes a major drag on the entire U.S. economy. To really get the impact, you have to know this one simple fact. Consumer spending is the engine of the American economy. It makes up nearly 70% of our entire GDP. So when people are out there spending, the economy grows. But what happens when all this debt gets in the way? Well, it creates this negative chain reaction. It's pretty straightforward. First, households have to put more and more of their income toward just covering interest payments. That leaves less money for everything else, going to restaurants, shopping, traveling. And the result is a direct hit to businesses and ultimately slower economic growth for all of us. And this right here is the key takeaway. We're not necessarily looking at some dramatic 2008-style bubble that's just waiting to burst. No. Instead, you should think of this as a slow, relentless squeeze, a constant pressure that just drains the financial resilience from households and drags down our whole economic potential. So the real question isn't about trying to predict some sudden crash. It's about understanding this ongoing pressure. How long can households and the broader economy that completely depends on them continue to function under the weight of this relentless squeeze? That's the question we should be asking. If you want to dig deeper into all these numbers, you can find a link to the original analysis right down in the description. And hey, if you found this explainer valuable, it would mean a lot if you'd like, share, and subscribe for more insights. You can find us, the What Bitcoin Taught Me podcast, on pretty much all the major platforms: Twitter/X, Nostra, Blue Sky, Threads, Instagram, Facebook, LinkedIn, Spotify, and now on YouTube too. Thanks so much